Hey everyone, welcome back to the Weekend Charts. Big show today. We're going to run through the latest employment numbers. We're going to talk about the housing market, rental market, and so much more. I'm Charlie Bilello, your host, and as always, we're going to run through the most important charts and themes in markets and investing. So let's start out with that labor market report. And what it showed really was that the labor market continues to loosen. So we had this situation in the labor market, really the tightest labor market probably we've seen in history following COVID. And slowly but surely, month after month, it's starting to loosen up. And so, what we have now in terms of a trend, well, 32 consecutive positive months for payrolls. So, a good sign. Jobs continue to increase. There's no reason to believe this won't continue for at least a few more months. But what we're seeing here is the unemployment rate ticked up to 3.8%. So, a little bit higher here. It was 3.5% the prior month. In April, we had that lowest level we've seen since 1969 of 3.4%. So a little bit of a rise in the unemployment rate. A lot of people saying, well, this is enough for the Fed to not hike rates at that September meeting. That seems to be what the market's expecting. And we'll talk about that in the Fed section. But what are some signs that are showing the labor market's loosening and that this rate of job growth is starting to decline a little bit? Well, number one would be just the change in overall jobs. So we saw this huge decline in jobs, and then jobs came back after that brief COVID decline, and they've been well above trend in terms of the growth. But now we're back to kind of trend growth, 2% increase over the last year. If we look at other things like job openings, what we're seeing is clear evidence that the labor market's loosening. So we're not seeing as many companies putting up offers for jobs. And this is the fewest job openings we've seen since March 2021. Definitely still above average, still above pre-COVID levels, but coming down on a meaningful rate. And some people say, well, this is lagging data, it's dated, the actual numbers even lower. Some signs that might be actually true would be something like the quits rate. So the quits rate is just measuring the percentage of people that are quitting their job, and we had record numbers in 2021. And since then, we've seen a steady decline. Now we're back to where we were pre-COVID at 2.3%. So this is a sign that people are feeling less comfortable quitting their jobs and looking for a new job. And that's probably because the number of job openings are coming down. And so what we have here is, in terms of the job openings per unemployment rate, a decline here, but at 1.5. That's the lowest we've seen since September 2021, but still above average. Still, the data argues that we're going to likely see further job growth in the coming months, but at that slower pace. So finally, in terms of labor market loosening, this is the big one that the Fed is obviously looking at closely, looking at wage growth. And at 4.3%, still definitely above the average from the 10 years prior to 2020. But this is the lowest we've seen since July 2021. So fewer jobs available, less demand for labor. Well, that's going to put less pressure on companies to raise wages. And this has been a big concern in terms of will this lead to an inflationary cycle where higher wages are going to lead to higher prices and kind of spiral upward. And so if this were to continue to come down, I think that would give the Fed enough evidence to say, okay, perhaps we can be a little slower here. We're going to pause in September, but maybe if we see this come down again next month, they'll pause again in the meeting thereafter. So labor market's loosening, but great sign is that it's still expanding. And number two would be the labor force participation rate, which if we look at the overall rate, it moved up to 62.8%. That was the highest since February 2020. So almost at pre-COVID levels. And if we look at the prime age worker, so 25 to 54-year-olds, that's the highest we've seen since 2002. So people have not only come back to the labor force, since that COVID decline, but have now surpassed it. If we're looking at prime age workers, that's a good sign. Good sign for the economy, indicates strength in the labor market. So overall, pretty good report, but you have that higher unemployment rate, you have, if we combine it with the job openings and quits rates, it's just signaling that the labor market's slowly moving back to normal, slowly loosening up here. So let's talk about rents here. And this is a big factor in terms of inflation. Obviously, housing, number one component. And if you don't own a home, but you rent, that rental component of your monthly spend is, for most people, the biggest component of their budget. And for a few years, we saw record increases in terms of rent growth, but now that's reverse course. And actually, over the past year, if we look at the listing prices for rents, so this is not saying looking at a static rent and saying for that particular lease, what's the change over a yearly period. This is just saying a composite of all the listed prices for rent on this website apartment list. They're saying those rental prices today are 1.2% lower than a year ago. And that's the slowest rate of growth we've seen since 2020, negative growth. And for a lot of people, this is obviously a welcome sign. At least if your lease is coming due, you can argue that perhaps it shouldn't go up, and maybe even for certain people go down. But if you're new to the rental market, you're finally seeing lower prices on a year-over-year basis. And this obviously varies by region, but huge factor here. We went from, again, this huge acceleration in terms of rent prices to the opposite scenario. And if we look at how broad-based this is, I think this is a pretty good metric, looking at the 100 largest cities in the US in terms of year-over-year rent growth, and 72 out of those 100 are showing negative year-over-year rent growth. So it's not just a few cities dominating this. It's more than a majority, 72% of the 100 largest cities showing a negative year-over-year rent growth. That's even more than what we saw in June 2020. And if we look at that rental market, the two big components in terms of what's driving it is, number one would be the supply. And if we look at the supply, we look at the vacancy rates, it still seems to be trending upward. And number two would be new construction, so new supply, and that remains elevated as well. So there's a lot of good signs in terms of the rental market to expect not huge rates of appreciation, and perhaps even continued year-over-year declines, because you just have that supply-demand dynamic playing out in favor of low or stable prices. And that should be a huge factor in the months to come, as CPI operates with the lag in terms of pushing that inflation rate lower, at least the part that has to do with shelter and housing. So let's talk about housing. We covered rents. Let's talk about home prices. And here we're seeing lower home prices year over year. If we look at the Case-Shiller National 20 city index, so looking at these 20 cities within the index, down 1.2% year over year. You can see some cities are higher: Chicago, Cleveland, New York, Miami, higher year over year, but a number of cities are negative. It's pretty much split half and half in terms of positive and negative. And overall, we have that 1.2% decline. So we had this rapid rate of appreciation in 2020, 2021 into 2022. And now we've seen the reverse here, or at least we're not seeing significantly higher prices. This is not a huge decline for the housing market, given that it went up over 40% in a 2-year period. But nonetheless, this should be a factor as well in terms of, again, CPI operates with a lag, looking at that shelter component. And now we're already seeing it come down, and falling rents and falling home prices should be additional pressure, perhaps, to drive it lower in the months to come. I think that should be expected for that part of CPI. Next, let's talk about commercial real estate. So we're seeing much more pronounced prices in terms of commercial real estate versus residential. And that's a supply demand dynamic. There's more supply there, more vacancies, particularly in the office market. So this is one index of commercial property prices in the US. It's showing that they're down 16% from their peak in March 2022. So you can see we had that dip from COVID in 2020, and then we had that huge spike higher that we saw in the residential market as well. But since then, we've seen a real moderation in prices. So interest rate rises and the change in dynamic in terms of people working from home more and has hit definitely that office sector pretty hard. It's down 31% from its peak. So pretty sizable declines. And the expectation is this is going to be a cycle, and it's going to take a few years to play out because of the way the debt structure is comprised, and in terms of the term of that debt, a lot of that is going to start rolling off in the next few years. And these people who have these properties, have this debt, won't be able to refinance that, and they'll likely have to sell or just walk away from the property. So the expectation is that this is going to continue, and these higher interest rates that the residential market is kind of shrugging off. And we've talked about the reasons for that. People simply not listing their homes, so there's no supply there. Doesn't seem to be on the commercial side that same dynamic. The supply demand seems to be more supply, less demand, and that means lower prices for the time being. And so the question for the markets is going to be, well, when do market participants start to care? And that really comes down to really the financials, the banks, their exposure to this sector. And for a few months, there was that concern back in February, March. But today, there doesn't seem to be that same concern. Perhaps we'll just have to see the default rates go higher, and perhaps we'll have to see more economic weakness in other sectors as well, with rising defaults, let's say in auto loans, which we are seeing that tick up, in credit card delinquencies, and the rest of that. Maybe all of that combined will start to lead to some fear. But for now, it seems to be investors are saying this is an isolated issue, and it's not going to bring the entire market down. So finally, let's talk about falling investor demand for housing. So in 2021 and 22, early stages, we saw this record huge spike in demand for housing from investors. So interest rates were being artificially suppressed, driven down to record lows. Investors were coming in and buying these properties, very, very speculative, obviously, and you saw this enormous growth in terms of investors coming into the market. And now we're seeing the flip side of that. So higher interest rates combined with now prices for homes are not going up, they're even going down in some areas. And the fact that rents are now falling, well, that makes the property less attractive. All of those reasons are causing a huge decline in investor demand. So as compared to the second quarter of 2022, we're seeing a 45% decline in the number of investor purchases of residential real estate. And if we look at just the pure numbers here, you can see the huge variability over the past few years. First, that decline in 2020, then a huge spike higher, and now that move lower, so lower than where it was even pre-COVID. And if we look at the investors as a share of the market, well, we hit a record high above 20% here. And now we're coming down. Now it's about 16% of the market, still above, let's say, the average before 2020. So the expectation is this will likely continue. And if home prices start to really fall, we're just seeing a minor decline year over year. I would expect this to really start to come down, go back to kind of the levels that we saw after the last housing bubble collapse. So let's talk about the credit card business. And credit card business is booming for a number of reasons, but I want to focus here on Mastercard and their earnings report. Just a blowout earnings report. They had revenues up 14%, hit record highs. Net income was up 25%, a record high there as well. And importantly, here they're talking about the consumer. They're saying the resilient consumer spending, particularly in travel and experiences, and continued strength in services, is leading to these enormous numbers for Mastercard. The stock surged higher after the report. It was already trending higher, hit an all-time high, so fully recovered from the declines in 2022. And if we look at the last 10 years and compare Mastercard to the S&P 500, no comparison. You just have Mastercard far and away outperforming 621% increase versus 230% for the S&P 500. And what's driving that? Well, it's a combination of just fundamental growth. So if we look at revenues and net income, significant increase. So both of them have more than tripled over the last 10 years. So huge increases in terms of the fundamentals. But we also have some multiple expansion as well. So if we look at the price to sales ratio where it was 10 years ago, it's below 10 in terms of a multiple of sales today, over 16 times sales. So that combination is leading to that 600% increase. And why are our investors so excited about Mastercard? It's a great business, and business is booming. If we look at that net profit margin, huge here, over 43% net profit margin for Mastercard. So they do a lot with a little. If we look at the number of employees Mastercard has compared to most businesses, and we look at the net income and revenue it's producing from those employees, it's at the top of the list in terms of S&P 500 companies, and the market is valuing it as such. So uh, if we look at the fees that are paid, it's not just Mastercard, it's Visa as well. So the fees paid to credit card companies, to Visa and Mastercard over the last 10 years plus. So this goes back to 2012 data. Just up and to the right, huge increase here. 2012, you're looking at $33 billion in total payments from merchants to Visa and Mastercard. And in 2022, that hit 93 billion. And it doesn't seem to be stopping, because when I did this analysis, there was this report saying that Visa and MasterCard are going to raise their credit card fees once again, another 500 million in annual fees, which is not a huge amount given they're already over 90 billion, but they're able to raise these fees again, which means they have some pricing power. So just incredible business. One would think that this would have been disrupted, that these card companies wouldn't be getting these high transaction fees for every transaction that you have, things like Apple Pay and many other things, where it makes it pretty easy to make purchases. Someone you would think is going to come along and figure this out and do it at a lower rate than Visa and MasterCard are charging. But for now, just huge margins, and they're still raising fees. So pretty incredible. Would obviously benefit everybody in terms of the consumer and the merchants themselves, if they could figure out a way to reduce this, because it's an additional cost. And I think you're seeing more businesses tack on fees if you're using a credit card. So because they have to pay Visa and MasterCard a few percent often when you make a transaction, you're seeing more and more retailers saying, well, if you use a credit card when you check out, you're going to have to pay this additional fee. And it's encouraging a lot of people actually to go back to cash, perhaps, if that percentage is high enough. So we're seeing it at restaurants, we're seeing it at more retail locations. So it'll be interesting to see if someone comes in. If we look at the way free markets work, someone should see those fat profit margins and come in and take those margins. As Bezos once said, I think he said, your margin is my opportunity. So someone like Amazon, perhaps, or Google, or one of these big tech companies is likely to come into the space and disrupt this, or perhaps it'll be just someone totally different, a new entrant. But for now, pretty great business, and the market is rewarding these companies. And as a reflection of the U.S. consumer, we talked about all summer about that travel spend that was keeping the economy going. Well, this is further evidence that that indeed did happen. If you look at MasterCard, the earnings report, it's being reflected that consumers are still spending, and spending at a pretty rapid clip. They just shifted what they're spending on more on travel and experiences and less on consumer goods. So let's talk about the commodities market and the shift from a tailwind for inflation, meaning helping to drive inflation lower, to a headwind for inflation, I think, to come. And what we're looking here is the national price of gasoline, the average price that consumers are paying at 382 per gallon. And if we look at here, that's the red line. We have this blue line here showing what they paid in 2022. And for months, there was this gap, right? We had that huge spike higher in 2022. Gas prices hit a record high during the summer of over $5 a gallon. And then they declined in the back half of last year. And for much of the past, let's say 6 months, what we've seen is that year over year decline in gas prices was helping reduce inflation or helping to reduce CPI. But now we seem to be at a crossing point where if we look at the year over year change and gas prices were essentially flat. And if we maintain these levels or go up from here, it's actually going to start to be a headwind because you're going to see higher prices than a year ago. So we could see that in September. If we look at crude oil, similar story here, highest levels of the year, $85 a barrel. So up significantly from the lows that we saw back in June and back in May and earlier in the year, up over $20 a barrel from the lows this year, and actually now up on the year over 6%. And if we look at commodity prices, I do this every week, looking at commodity prices year over year as kind of a gauge on this portion of inflation. And what you'll notice is the numbers are becoming less negative. So for a long time, we had crude oil down big year over year. Now we're almost flat, and probably going into next week, if we hold these prices, you're going to see positive year over year numbers for crude oil, which is the biggest commodity in the market. And gasoline prices are already above year over year. If we look at gasoline future prices, copper now up year over year, things like gold and silver up year over year. So as this shifts, if assuming this holds, you're going to start to see less of a tailwind for CPI. For now, the good news is that the agricultural sector, if we look at things like wheat and corn, they're still down year over year. Natural gas as well, positive, almost down 70% year over year. That's a positive as well. But these other factors, particularly crude oil and gasoline, are going to start working against CPI. So what are the expectations? We're going to get the CPI numbers next week for the US. And what the expectation is we're going to see a bump up. So we got that 3.2% number last month. The expectation is that's going to jump up to 3.8% for the August number, and then even a little bit higher for September, 3.9%. But at the same time, Cleveland Fed saying we're going to see lower core rates of inflation. So core CPI will be trending lower while overall is higher. And the reason for that is simply housing dominates that core CPI number. And with a lag, it's going to start reflecting what we just talked about in terms of falling rents, falling home prices. Well, now that's finally starting to be reflected in terms of the shelter CPI numbers. So core rate should still continue to go down while overall goes up. The question is, well, how is the Fed going to react to that? What the market is saying is that the Fed's going to at least pause for September, 95% probability that when they meet on September 20th, they're going to hold rates at 5.25 to 5.50. But if we go to that November meeting, this has shifted from week to week. This continues to shift back and forth. But for now, market's saying a little over 40% probability that the Fed will hike again in November. So a lot of that is going to depend on how these numbers shake out right here. And of course, the subsequent employment reports. If we see a CPI number start to push over 4%, I think you start to see an increased probability that the Fed will do at least one more hike at that November meeting. If we don't get that, perhaps a different story, and perhaps depending on where the core rate, how much it comes down, that'll be a factor as well. But regardless, the expectation is the Fed is almost done. The market's been wrong about that a few times this year, so we'll see. But the September meeting is going to be important because that's when they release their economic projections again, including what their forecast is for the Fed funds rate. So at the September meeting, they'll say, well, this is where we think that the Fed funds rate is going to end the year. And if they say it's going to end the year in this range, well, I think the market's going to say, okay, perhaps we're going to have one more hike. If they change it to say we're going to end the year over at 5.25, 5.50, then perhaps there'll be a higher expectation there. So a lot of data points between now and that November meeting. But for now, it seems like the September meeting, done deal. The Fed will just pause for that meeting. So I want to end, as I do always, with a positive note. And so I hope everyone had a great Labor Day. And I want to talk about a few longer term labor market trends that are highly encouraging and really show an increase in prosperity today versus where we were back in the 1950s and 1960s. which a lot of people call the good old days and say that things were better back then. But if you look at some of the statistics, including the number of hours worked per worker per year, you can see a consistent decline since 1950. This is looking at high income countries, including the US. And back in 1950, let's say the average worker worked almost 9 hours a day. Now it's over an hour a day less in terms of the number of hours they're working. This is looking at the yearly hours, but if you translate that into daily hours, it's over an hour a day less today than it was back in 1950. So the question is, well, does that hurt our prosperity? And the answer is not at all. We've become a much more prosperous nation in the US here. This is looking at real incomes, looking at starting point in the late 1950s at 100, and then where we are today, and you're looking at almost a 4x increase in terms of real incomes in the US, despite the fact that we're working fewer hours, much fewer hours than we did on an annual basis back then. So great news here, long-term trend. Hopefully, obviously, this continues. And so with that, we'll end it there. Thanks everyone for joining me. As always, if you like the content, subscribe to the channel, and I'll see you next time on the Week in Charts. Thanks.